Hi everyone, welcome back to this week's Expat Investor Podcast. My name is Tom Pewtress, Head of Global Partners at Skybound Wealth Management. Good to have everyone along. I've not been around for a couple of weeks now and we've had some special guests on over the last couple of months or so, which has been great to see on the podcast. Today I'm joined by another guest, Simon Athwal. Si, welcome.
Hi, Tom. Yep, thanks for having me.
No, my pleasure. First time on the podcast?
Yeah, first time. Probably won't be the last. Yeah.
Well, it's good to have you. You and I have worked together now for, must be 5 years or so, 4 or 5 years, right? And a good time together it's been. But today we want to look at and talk about property as an asset class, right? And, you know, as financial planners, wealth managers, whatever label you want to call us today and whatever job we do, property is always an asset class that people are drawn to. And it's always something that we get questioned on and quizzed on. So why is it that people typically get drawn to property? I mean, what do you think draws people to property initially?
Well, I mean, I think it's just people just like something physical, like a tangible asset, something to look at, something to hold. I mean, property historically is always, done very well, especially in the UK. It's always capital appreciation. And I think it's just something that's like secure, something that's, embedded in our brains to say, look, get a property.
It's weird, isn't it? Definitely in the UK, like when you grow up in the UK, certainly, we're similar age, right? And we grew up in the UK and went to school in the UK and it was all like, I don't know, like my memory of growing up was go to school, go to university if you can, get a job, buy a house.
Yeah. Exactly.
Right. And then they were like, they were things that you had to tick off through your journey.
Yeah. And I think that's just what people have just thought now. It's just that's the next stage on their ladder. To get that.
And I think a lot of people have seen other people then buy a property and then buy a couple of others and ended up with rental income, right? As a way of growing wealth and making wealth and creating wealth. And I think sometimes in the UK as well that I actually sometimes think we're a bit shielded from other asset classes in the UK. There isn't the financial literacy around mutual funds, ETFs, investment accounts in the same way that there is buy a house, get a mortgage. It's like that seems to be very mainstream where everything else is not for all intensive purposes. So when we're talking about that, when we're talking about property and investments and making other investments into property, obviously that's buy to let, right? It's buying to then to rent that property out. Why is that a good idea? I mean, how does that come to be a good idea? Why is that a success for some people?
I think buy to let, I mean, it's just something that you could, use the power of leverage. You can put down less capital in order to get yourself a bigger asset. You can live off the rental income in the future and then live off the sort of capital appreciation in the future as well. It's just something that people have seen as grow.
I think leverage is a really powerful tool, right? And it's one of those things that you don't have the opportunity to use it in too many other places when it comes to investing. What does it mean to leverage an asset? Like, what is that? What is that concept?
I mean, typically an investor would put down less capital in order to buy a bigger asset. Okay. And then, let's say property in this instance, they would buy a property with a sort of less deposit, not pay it in cash, and then use the rental income to pay off the debt. So the property is increasing in value while the debt is decreasing. Okay. And then later on, when you can use the equity in the house as it increases, you can release that equity and buy another property. Okay. So you're just leveraging
yourself all the time.
Yeah, pretty much.
At outset, you've got that. Let's take a working example. Most people will understand this concept, but we've got a property asset today worth 300,000. As an investor, I'm not having to put the full 300,000 in because I've got the ability to go and get a mortgage for the other 65-70% of it, right? So I can put down 10, 20, 30% today to purchase a property, which means, like you say, you're not having to put in as much. You can put down less, but you're buying an asset, and actually the way that works is if that property goes up in value, you're benefiting from the whole value going up, not just your portion of it going up.
Exactly.
So if we've got, let's use really easy numbers for a second, but if we buy a house for 100,000 and the asset is worth 100,000 and we only put in 30,000, if the property goes up 5%, it's gone up to 105,000. we've actually made 5,000 return on a 30,000 investment. So you're almost looking at a 20% return in that aspect. And that's the power of leverage, right? If you invested 30,000 and something went up by 5% on 30,000, well, it's only 15. It's only a 5% return, right?
Exactly.
It's by leveraging yourself, by buying a bigger asset, and that growing by the percentage points that it does, your return on investment is actually much greater than the 5% that it's grown, because you've not put in the full amount.
Absolutely, yeah.
And that concept of leverage is powerful. I think, when you talk about buy-to-lets and capital appreciation, it's that leverage factor that allows property to become very successful over time, right? And however long it takes for that asset to double in value, the reality is that you've never put in 100% of the invested capital, because you've got, like you just said there, things like
this is it.
Rental income helping you pay down that debt.
Yeah.
So that is, I think it's something that people don't give enough credit for on property. I think everyone understands that property is a successful way to invest, but they don't necessarily understand that that's why it's successful.
No, I think that's also embedded from the fact that some people don't even like the debt.
Yeah.
Again, it's the same thing as getting a mortgage. I don't want to have a mortgage when I'm nearly retirement.
Yeah,
but if you use the power of leverage to have a big mortgage, then let someone else pay the debt for you. You're still going to have the same capital at the end of the day. You're still going to get that 200-300K, but you haven't paid for it yourself. You've let someone else pay your debt for you.
Exactly. So when we look at mortgages, let's just talk about debt, for example. Debt's an important part of our day job, right? We spend a lot of time talking to clients about their income and their expenses and what's good debt and what's bad debt. And typically longer term debt is better debt if it's got a lower interest rate associated with it. Shorter debt, credit cards, personal loans, potentially bad debt for all intents and purposes because of how expensive that debt can be. And controlling debt, right? And I think if you listen to some people out there, there's definitely some people on the internet that will tell you any debt is bad debt.
Yeah, of course.
But it's about being sensible with debt and understanding, your limitations and making sure that things are affordable when worst case scenarios do happen. And we'll go on to talk about that in a second. But what are the different types of mortgage that you can get? We've got capital repayment and interest only. What's the difference between those two types of debt?
Well, usually capital repayment, you're paying off the capital of the property as well as the interest.
Okay.
But interest only is pretty much that. You're just paying off the interest only, which, yes, it reduces your cost.
Yeah.
And so you're able to make more money per month. But at the end of when the mortgage ends, you still have to have a strategy to pay that principal debt on the property. You still got to pay the property because you only paid the interest. So out of the two, people have different strategies depending on your age and etc.
And what you're trying to achieve over the longer term.
Exactly,
right? I think, again, where you say there, it's like where people are potentially looking for a bit of an income. Yes, having an interest only can create that for you because that repayment is a bit lower than potentially what the yield or the monthly income that you're getting from the rent, right? So it does clear you some. But again, what's the purpose behind it? Does it fit the financial plan? Do I need that extra income today? Versus, actually, I can pay this whole asset off just using that income that's coming in, and I can get that repayment done over that period of time.
Exactly, yeah. There's no right or wrong. It depends on your strategy and your objective.
And this is the point, though. I think there's a lot of people that will tell you there is a right and wrong.
Yeah, with what they're used to.
Yeah.
But unless you understand both concepts, then you don't know which decision to make.
Yeah.
So if you understand both capital appreciation, interest only, or even just using completely your cash, then you can sort of think to yourself, well, when I get to retirement, do I want to live off the income only, or do I want to sell the asset and use that? There's different strategies, but then someone would need advice for that.
Yeah, and again, it's just understanding the personal circumstances, isn't it? And just looking at the cash flow and understanding what happens further down the line and the benefits and the pros and cons of each of them. Do you find a lot of people, you've been working in the Middle East, Simon Athwal, the last 5, 6, 7 years, whatever it may be.
9 years, actually.
Is it 9 years?
9 years,
Jeez,
yeah.
Wow, where does the time go? So that's just a representation of how long we've been working together. It's like when I met you, I think you were out here 5 years, and now we're 4 years later.
This is it, right? Yeah, it does go fast.
It goes really quickly. And actually, I think we have this conversation quite frequently between ourselves at work, and it's like, do we buy out here? Do we continue to rent in the Middle East? And we both love living in Dubai, and we definitely can't see ourselves going anywhere anytime soon. But we haven't purchased property out here, as many people haven't, and some have in the last few years, etc. Do you find a lot of people are in that quandary as to, do I buy here or do I buy back home?
Yeah, I think it's quite, people go into the hype, don't they? They believe the hype, and it's that concept of, if everyone's buying it, I want to buy it.
Yeah.
You don't understand that, certain countries have different stabilities.
Yeah.
There's a lot of market volatility in globally.
Yeah.
But probably more Middle East than Dubai.
Yeah.
Middle East than the UK.
Yeah.
You think about it, UK is such a small country. Typically, there's more demand than supply.
Yeah.
Whereas in Dubai, it's the reverse.
And I think the other thing as well to consider is, property prices, the property that you might want to buy and live out here, you can potentially afford the rent, but not necessarily get the deposit together. Obviously, there's quite big deposit demands here for the type of properties that people are purchasing. I think one thing that I always say to people is that, you're probably going to want a house to live in when you're retired, and most people have the goal of not having a mortgage or a rent to pay when they get to retirement, right?
Yeah.
So whether you're paying the mortgage off whilst you're living here, or you've got a house back in the UK that somebody else is paying off for you, the end result is when you get to retirement, there is a capital that you can pick up, move,
Correct, yeah.
and go and buy the house that you want to live in forever. So I think I've certainly met a lot of people over my 10 years here that have got caught up in that decision. And it's something I think it's impacted them badly because they've been unable to make the decision. It's like, I want to buy here, but I haven't found the right place, or I know that their primary reason for buying somewhere is so that they can start to pay capital off over long periods of time and have that capital base to move into in retirement. But they get stuck on that decision tree of, I'll wait for the right place to come up here.
This is it. It's an emotional attachment.
Right, it is. Whereas kind of that investment property, that buy-to-let mentality that we've spoken about today, that's not, right? That's just pure numbers.
You can't be an emotional attachment.
Yeah.
My wife, she says, let's buy this house, and she goes, I want to do it up and make it look nice. You're not going to live there.
Yeah.
So why would you want to do that? It's not a property. I don't see property as a property.
Yeah.
I would see it as an investment.
Yeah.
Numbers game. Exactly. You shouldn't put all your money into property, and nor should you put it all into cash or into investments. And we know that it should be a balanced portfolio.
Yeah.
You should de-risk and invest in all three things. But you do get people that get into the stage of buying 5 or 6 properties, and whilst that's good for rental income, there's obviously other things you need to think about, like costs and tax, etc. So this is where people need to start thinking about the pros and cons of all types of investment.
Yeah,
including property.
So let's just go back to that. And you mentioned UK property earlier. Easy for us, we're from the UK. Much of our client base is from the UK, but much of it isn't as well at the same time, right? And we deal with people from all over the world, from all different jurisdictions, all different walks of life. You said earlier that the UK continues to be a strong rental market because it's a small island with loads of people on it, not enough room, right? That's obviously played favourably, right, in terms of its performance and the stability that sits around it. But what other reasons, you've already kind of touched on it, but what other reasons are you looking for when you're looking at an investment market? The UK is not the only market to invest in per se, but it's definitely one that we would look to.
Yeah.
But why is that?
Well, you've got to look at there's a few things. You've got to look at obviously location, the volatility, the population. But I think with the UK, it's historically property's always grown, and I guess there's a strong financial backing there as well, especially from a legal point of view. There's a good legal framework. There's a strong sort of economic point of view, and I think people just gravitate towards the UK because they know it's just stable and secure.
Yeah, London's always had that kind of appeal, right? But I think certainly when we look at it, you just touched on it there as well. It's even when you do look at the UK, there's probably parts of the UK that you wouldn't want to invest in. And then there's definitely parts that you do want to invest in. And again, it goes back to that. It's not a property, like you said. I like that. Like, don't look at it as a property. Look at it as a numbers game. Look at it as an investment. You know, does the numbers stack up?
Exactly. And, you know, I did have a client today actually that said, you know, I want to buy a property in Oxford, that's where my family's from.
Yeah.
I say, well, you're not going to live there, are you? So
No.
He's got no intention of going back there. So why don't you look at other areas that have better yield?
Yeah.
It doesn't have to be that you know the property that you want to be in. It has
Do you find that a lot with people like want to buy close to home, or where they're from, or where they've got family and
It's
friends?
quite common because people want to be back to, you know, where they grew up. It's a nostalgic thing. But like we said earlier, the property, investment property doesn't have to be, it shouldn't be an emotional attachment.
Yeah.
It should just be an asset that someone else pays for you. And that's why other areas like Manchester and Birmingham are up and coming, because I think people are realising that London is now expensive or somewhere you don't want to be anymore.
Yeah.
So, you know, the UK is regenerating other areas up north.
Yeah.
And the connecting links between London and north. With big companies moving offices there. So I think people are starting to open their eyes a bit and invest in other parts of the UK. Not necessarily.
You just have to understand that as well, right? From a case study point of view, it's like, well, why would I buy a property in Manchester today? You know, I'm from the north, and Manchester's nearly home for me originally, but it's like, what, you know, why would I? And again, it goes into looking at the numbers. What's going on in that city? What regeneration is going on? How many people are they attracting? You know, the UK has a big property shortage, right? And we're not property experts by any stretch of the imagination, and we'd always ask clients or anybody that's looking to diversify their wealth to go and speak to the experts. But from our point of view, we know that property is as an asset class, and that's how we look at it, right? It's an asset class that we believe should be a part of anybody's portfolio for the purposes of diversifying and mitigating risk in the future. But as we would look at buying a mutual fund or an ETF for somebody, or advising on any asset class, you know, we want to see some research behind it. You know, it's like, well, how many people are moving to Manchester? How many people are being retained in Manchester? How many new companies are being opened up in Manchester, right? And versely, how many people believe in Manchester? Like, is there a negative impact here of this decision? And that's really key to understand. Is Oxford doing the same thing as Manchester? Does Oxford have the same, in your example there, does Oxford have the same, do the numbers stack up in the same
numbers,
way?
Yeah,
right?
absolutely. You've got to look at the calculations between it, not just, you know, where it is, just, you know, do the numbers make sense, like you said earlier?
Do you think a lot of people buy property with the mindset of one day it will pay me? Or kind of a silly question, but, you know, I think a lot of people buy property because they like the income aspect. So do you think people buy property purely for that? Or do a lot of people go into that conversation well aware of, actually, I'm doing this because of the potential upside?
I think there's an argument for both, really. But I think people would sort of go towards the income. They don't really think about capital appreciation, because sometimes it happens, but I think more towards the income, because they know they're going to get the income. Some people might think I might make £200-300 off per month. You know, I tend to say, you know, it's irrelevant whether you make money or not. You know, even if you bought a property for 150 and in 10 years time it's still worth 150 or 155, and then your repayments, the rental income, are pretty much the same as your repayments. It doesn't matter if you're making money or not. What matters is that someone's paid debt for you. So in 10 years' time, that 150 is still worth 150. But it's now all yours that you have.
And again, that goes back to what we said earlier. That's that power of leverage, isn't it? Because you essentially, if you paid 150 for the property, you didn't pay 150. You actually only paid 10-20% of that, right?
This is it.
You know, you only put in 30 grand. So you turned 30 grand into 150. Like you said, it didn't really matter if it went up or down. It's like you've actually made a lot of money because someone else has paid that debt.
Exactly.
for you.
And then the extra money you had, even if you got 100k and you put that all into an investment, but if you split that, let's say 30 into a property, or if you can buy 2 or 3 properties with that same 100k, you know, it's using that power of leverage, of course. And I don't think people understand that, that, you know, good debt is a...
No, for sure. Is powerful, right?
This is it. People still want to hold on to cash sometimes.
And... It's really interesting, because even you've got things. UK property has historically been a good inflation beater, right? You know, it's been a good hedge against inflation. for all the reasons we spoke about. The population continues to grow. There's a shortage of housing, right? Those two fundamentals alone keep pushing property in the right direction, and with it, rental yields. Rent keeps going up every year with inflation as a result of it. And some people who have shied away from property or haven't been able to make that decision to buy property, right, as an investment decision. Maybe it's for the purposes of settling their principal residence or getting onto the second or third one as a potential. Are losing out on, and we've spoken about this quite a lot as well, Simon, which is having bits of income. Even if it is income of 500, 600, 700, whatever it may be, £1,000 a month, when you get to retirement, that is ultimately then inflation proofed because it's going to go up every year, right? As assets go. But that makes a massive difference to the rest of the portfolio, because you end up creating these pockets of defined income, these ultimately defined benefits, right? It's like, I bought an asset, I've set my money to work, it's increased my asset base significantly, and now I'm living off of an income that's associated with the purchase price, not the investment price. Yeah. Right. And for having those, it's really truly unbelievable, and I can't really explain it without a graph. But having $1,000 a month, £1,000 a month, or euros a month, whatever it is, can help you retain the other investments that we make for people in things like mutual funds and ETFs last so much longer, because the drawdown rate from those is not as quick, so that they get to last so much longer. They've got so much more time in the market to grow, right? And that's why diversification is key, because those two things go hand in hand. It's not a one or the other conversation. And it's getting clients to understand that, well, if you do that and you create an income, that just doesn't create an income for you. It helps the rest of your wealth last so much longer. And a lot of the stuff that we do with clients, and we have a lot of fun with, is kind of cash flow analysis, is getting clients to understand the probability of success for their future, and getting them to understand, well, what's the likelihood of my money lasting? One, yeah. And how long is it going to last, and what's it going to be worth, right? But we've spoken very highly about property because we believe it as an asset class.
Yeah.
But nothing is always pretty in pink.
No.
Right?
No, we know that.
What do people need to be aware of? Let's concentrate on the UK as an example, because, the UK is a taxable jurisdiction after all. But what do people need to be aware of when they're looking at a property investment?
Well, I guess the most common drawbacks are, you've got interest rates hikes that we've seen recently, and people can't afford to pay for their monthly income, and then the rental income doesn't stack up with that.
And stuff, yeah.
And then you've got, the maintenance costs, and you've got tenancy issues if you can't rent it out consistently. And, they've got taxes in the future. If you start to build up a good property portfolio. So I think people just need to be aware of the market volatility. Property is good, but it's not be all end all.
Yeah.
And like you said earlier, this is where diversification actually helps, because, we've said it time and time again, you shouldn't put all your eggs in one basket. Yeah. You should just do both. And I think this is where investing in other asset classes helps, because there are drawbacks to property.
Yeah.
But if you have other investments can actually offset those.
Yeah.
So, it's something that's not correlated to the market, but at the same time with property, if you have maintenance costs and, you've got other costs that come up, and you can't, and you have rent, well, you don't have tenants, and you have fallow periods, well, you've got other investments to fill that void.
Yeah.
And this is where having a balanced portfolio is really important.
Yeah, I think that's key as well. Yeah, I think a lot of people, especially if we go back to kind of 2008, 2009, when again, historically, Brits have been very property heavy, got lots of property, and then you go through periods of time when high interest rates occur, people can't afford mortgages, they're probably leveraged a bit too highly, right? And it's getting the right leverage, right? Like we said, it's being sensible with leverage, understanding debt, understanding the risks associated with it, understanding whether or not I'm going to be able to pay that mortgage, understanding whether or not there's ways to mitigate that through things like insurance, right? Which I know you speak very, very much about when you're talking to clients and getting them to understand those risks. And then tax, right? You know, in the UK, we've got things like tax. You know, if you've got rental income, you may be paying personal income tax on certain rent, depending on your personal circumstances. Again, if you've not structured your assets properly, there may be things like inheritance tax, right, to think about at the very end, and how you can protect against that, or what you can do to structure your assets in a way that helps mitigate some of that, or allows you to pass as much of that on as tax efficiently as possible. So it always is important to think about those things. But when we were talking a minute ago about interest rates are really a hot topic right now, right? You know, we're in a world where inflation's definitely been high. The UK's done really well, actually, and has got their inflation down significantly from where it was. You know, they were one of the worst at one point, right? Yeah. And hopefully interest rates will come down now as a result of it. But when we look at property investments, we typically look at two types. One is off-plan and one is completed today. Just quickly, what's the definition of an off-plan for our clients out there today, or prospects?
For viewers, I think so. Off-plan is typically buying property that's not completed or built yet.
Okay.
So you'd buy it now, and then you put down a reservation fee and you secure the property, and then in about 12 months' time or 24 months' time, it's then completed.
Yeah.
Versus completion, which is pretty much what it says in the tin. Yeah, it's built, it's done already. Mortgage straight away, get a tenant in straight away.
Yeah.
So those are your two typical types.
What would be the benefit of buying off plan?
Off plan, I mean, typically they're cheaper compared to completion, because you're buying it not built
ahead of time. Yeah. Taking some risk there for that for intensive
exactly.
purposes.
Yeah, you don't have to put down the full deposit today either.
Okay.
In some cases, you can put down a smaller amount, and you can customize it yourself as well, and make sure and you've got yourself time in waiting for it until it's built, so you can build up your other assets and build up your investment if you want to pay it in cash.
Yeah.
And I guess completion is also good because you can rent it out straight away.
Yeah.
So
get a return.
you can see it there. But at the same time, because you can see it straight away and you can physically touch it, then you've got people renting straight away, so you can get the income straight away.
Yeah. And again, that might just come down to what you're looking for, right? If you're young and early on in the journey of wealth accumulation, then off plan probably is the best way to go, because, like you just said there, you're potentially picking up some discounted prices in that asset, because it's not built yet, right? It's not realised its full value. You're taking a risk by getting in a bit earlier than a completed project, so you may see an accelerated appreciation over that build period. Yes, you don't have the rental income and you've not got the ability to pay off that mortgage at that period of time, but you're far enough out from your journey of building wealth that may make sense. Somebody who's looking at a completed project is probably somebody who's looking for instant income, right? Potentially, looking for, somebody who's retired, potentially paying cash all for the property, and having that money then pay him or her back over their retirement or whatever period it may be. So,
although that's more expensive.
Yeah.
So like you said, both projects, it just depends on your lifestyle at the moment. Have you got the time to wait?
Yeah.
And sometimes there are delays.
Yeah.
But have you got the time to wait? And if you want something now, rental income now, maybe typically if you're close to retirement, then go for the completed.
Yeah.
But at the same time, when it's completed, you need to get the mortgage there and then as well, or you have the whole cash.
Yeah.
So it really, off-plan has become increasingly popular now compared to before. Before, everyone used to not trust off-plan.
Yeah.
It just used to be, I just need to see it now. But I think...
Why would they not trust off-plan?
Just because I think they can't see it and they don't know. It could be construction delays. There could be difference in what has been said and what's been completed. And, developers maybe go bust.
And that's a risk, right? And that's why you're getting a discount. You're running some of those risks. And
exactly.
Again, if we're ever looking at speaking to an expert on property, or we're looking at developers with a client and they've got opportunities in front of them, then there's certain things that we want those clients to see, and it's like fully funded projects. Can this developer deliver this no matter what happens kind of scenario? You find I think a lot of mistrust was built on off-plan projects, because projects, and again, I'd say the UK less now than before because of the legal system that sits around the UK, and certainly that promotion of making sure that developers can deliver. There's other parts of the world where people are still putting money down and putting deposits down. Those developers are relying on those deposits in order to get it out of the ground, in order to get the next 10 floors on, and
Exactly, yeah.
and then there's pressure from the developer to sell those units. So if they can't raise that capital, if they can't sell those units, and that's when these projects run into problems.
But where there's that risk, there's also a higher return because it does get completed, and they've exponentially, increased their property value.
Yeah.
And
exactly. But that's just, that's the benefit of buying off plan. I think when you're buying off plan, you've just got to be sensible about who you're putting your money with, right? Exactly. You want to know that you've got a fully funded project. You want to know that it's been backed in a good way, that it's with a good developer that's got a proven track record. Like anything, right? It's just like, would I trust my best mate who's never built a house before to build a house with my money? No. So why would I trust a developer to do it that I don't know to do it with my money? I want them to do it with their money, and then I'll buy it and pay them for it. And I'm still jumping in early and taking a risk because I don't know what it looks like. I don't know what the region around it's going to look like. I'm doing it well ahead of time. I don't, it's that conversation of, time versus money, right? So, okay. So there are those differences between completed and off plan. Obviously there's the benefits and potentially the cons to both of them, right? But if you were looking and talking to somebody that was buying off plan, you said off plan's become very popular. You mentioned kind of the process would be reservation fee today. Yeah. Just like, what does that mean? Well, why would you put a reservation fee down? Why are you making a reservation form?
I think the process usually is you put down you fill out the reservation form, you put down the fee of a small amount, and it takes it off to market.
Right. Okay. So it's just securing that
unit, and it's off. And then after that, you can exchange the contracts, and that makes it legally binding. So at that point, you would put down maybe 10 or 20% as the actual deposit. Then there's a legal contract between you and the developer. Yeah. And then that's yours. And then until completion, then the next stage would then be looking at mortgage, looking at lenders, securing that. And then when it is completed, then the mortgage will be taken place, or, you pay for the rest in cash. So, typically the process is just paying between 5 and let's say 20-25% now. Yeah. And when it's completed, then it's the handover process. So you got yourself some time until, to build up that other capital that you need for the property, or Makes sense. For the mortgage, and then maybe other admin costs at the end.
Sure. And I think this is one area that, again, we've always told clients to be aware of and be conscious of. Everybody's circumstance is different. Every development's different. If you are looking at mortgages, make sure that you can obtain a mortgage. You don't want to get down that road to find that you can't get that mortgage in place. So it's really important you just go through that process. And that's sometimes why I think as an expat, we're both expats. We've been about expats for a long time, and a lot of our clients are expats. But again, I keep references today, but a lot of people aren't making these decisions, or people aren't moving forward with these decisions because they don't know the journey. And I think that's why it's important to work with, a planner, people that have got expertise, people that can point you in the right direction and leverage other experts in the field. To get you to make those educated decisions, right? And get you to be aware of what's going to come down the pipe. Because I think a lot of people actually sit back and miss out because they don't know, or they're uninformed, or they're everyone seems to want to buy property, but sometimes people struggle because they're not sure where to turn to. So I think a lot of the time it is about just leveraging expertise, right? And that's why working with someone like you has obviously been very fruitful for a lot of your clients and everyone at Skybound. It's just about making sure that you've got somebody to talk to. Fair to say?
Yeah. It doesn't have to be an expert in everything, but someone you can just, have a conversation with. And, essentially what we do is not just providing the property, it's actually looking at, does it make sense for you? Yeah. Does it fit in with your circumstances, in terms of your whole objective, your whole strategy, essentially mind map. So I guess it's important to talk to someone just to you have an objective point of view to say, do I even need a property? Yeah. Or do I not,
And that's a good question, right? Because I think some people just are like, I'm going to buy property. It's like, why?
Yeah, exactly.
Why would you do that? That doesn't make any sense with what you're trying to achieve or where you're going or, and a lot of people are like, but Dave down the pub bought property and he did all right out of it. Yeah. But that's Dave. That's not you.
Exactly.
So yeah, I think you're right on that, right? It's like everyone's different.
We just, if at any point you need something just to have a talk, it's always good to get expertise in all walks of life, not just from wealth managers, but for anything you do, just so you've got a second opinion.
Look, time's flown today. It's been good to have you on the podcast. Okay. Have you got any kind of last words for the viewers out there today? Anything that you want to leave them with as Simon Athwal?
I would say don't put all your eggs in one basket. Talks a lot about, property is very good, but don't put everything into property or into investments. You want to do both. You want to diversify and plan and balance your portfolio and have different income streams. And, this is why we're here. This is obviously why we do our job, just to help you, meet your objectives.
Perfect. Look, thank you very much for your time today, Simon. It's been great to have you on the podcast. Hopefully you'll come back and visit us again. Viewers out there, thanks for joining us today. We look forward to seeing you again on the next episode of the Expat Investor Podcast.